Hello students, welcome to week 4 of our course, and today we will continue our discussion where we have stopped uh, on last week. Last week we were discussing about the bonds, and in last lecture we have discussed about bonds. Basically bonds are referred to as debt securities, and we have discussed in detail the difference between debt securities and equity securities. Debt securities are just like loans, they are financial assets of every company, and equity securities are basically they are shareholders. Equity security holders are basically the shareholders of the company, they are the investors of the company. And when we invest in bonds, the issuer of the bonds, they are supposed to give us a fixed return for a specific time period. They are supposed to give us fixed return for a specific time period. Today we will move our discussion further. We have three different classes of assets: equities, fixed income securities, and alternative asset classes. Equities are basically when these are from the investor's point of view. When you purchase the shares of a company, these are called your equity assets. Then you have fixed income securities, just like bonds. Bonds are basically your fixed income securities, because when you invest in a bond, then you will receive a fixed income, which is the bond interest. Then you have alternative asset classes. Asset classes will include all kinds of investments. Either you can invest in a business or invest in some other kinds of options. These will be included as alternative asset classes. Now, fixed income securities. As I told you, the point of our discussion in this topic will be on the bond securities, which are called as fixed income securities. It is a financial obligation of an entity that promises to pay a specified sum of money at a specified future dates. When we invest in a bond security, then we are going to receive fixed income for a specific time period. The entity promising to make payment is called the issuer of the security. So in case of government bonds, the issuer of the security will be government, and in case of a corporation, the issuer of the security will be the corporation. We basically divide fixed income securities into two categories. First one is the preferred stock. Preferred stocks are basically hybrid kind of securities. In preferred stock, basically they contains the characteristics of both debt securities as well as equity securities. Now, as our main concern is on the debt securities, on debt obligations, so basically they are divided into four different categories: bonds, mortgage backed securities, asset backed securities, and bank loans. Bonds we discussed many times. Mortgage backed securities, basically we give a collateral in case of any kind. These will be called as the mortgage backed securities. Then we have asset backed securities, just like we give a collateral for any kind of asset, just like building, land. These securities will be called as asset backed securities. Then we have bank loans, the loans we are getting from the banks. These are called this is the fourth category. Now, bonds, first one, that will be our prime focus of our discussion. Bonds are debt instrument in which one party lends money to another party to determined terms and conditions. What are these terms and conditions? Predetermined terms and conditions. First of all, rent of the interest to be paid, which will be fixed. Periodicity of the payments. The rent rate of interest will be paid after fixed time intervals, fixed time periods, and repayment of the principal amount borrowed will be paid at the end of the period. These are the most important and most common terms of every kind of bond. So there are certain features of the bonds. First of all, indentures, which is referred to a document where the promises of the issuer and the rights of the bondholders are set forth in detail, is called the indenture, or we can say that it's a written document which explain all terms and conditions of the bonds. This document is called indenture. Covenants are basically, we divide covenants into two categories. First of all, affirmative covenants and negative covenants. Affirmative covenants, they are the activities that the borrowers, these are actually the responsibilities of the borrower, and negative covenants, they set forth the restriction on the borrower's activities, Then principal basically it is the face value of these bonds. This is the original amount of the bond which we have invested. If the bond value is issued at par value, then the par value or original value will be called as the principal amount. And if it is issued at less than par value, then we can say that the bonds are issued at discount. If the bonds are issued at above the par value, then we can say that these bonds are issued at premium. The coupon rate is basically the interest rate at which the issuer agrees to pay to the investors. Normally we calculate the coupon interest amount by multiplying coupon rate with the par value or face value. Now this is the explanation of issuing at par, issuing at discount, and issuing at premium. If the bonds are issued at the original value, it is called as issuing at par value. And if the bonds are issued, this is basically the par value is the standard value. If the bonds are issued below the par value, it is called we have issued the bond at discount, and above the par value will be referred to as premium. Maturity, basically based upon the maturity is the lifetime of these bonds. According to the lifetime of these bonds, we can divide bonds into three categories: short-term bonds, intermediate bonds, and long-term bonds. Why maturity is important? Term to maturity indicates the time period over which bondholders can expect to receive interest. So based upon the time to maturity, or based upon the maturity time period, we can decide, the investors will decide the original value or the real value of that bond. Real value, or we can also call the real value as the yield on bond. Yield on bond is the rate of interest that we can earn by investing in that particular bond. It totally depends upon the time to maturity or the term to maturity. There are multiple kinds of the bonds. First of all, zero coupon bond, the bonds in which no interest payment or no coupon amount will be paid. No interest payment is paid, is called the coupon bond. Now question arises, if the investor will not receive any coupon, then what will be the motivation? What will be the motivation to invest in these kinds of bonds? So basically, the zero coupon bonds are always issued at discount. They are always issued at discount, and they are redeemed at par value. So the difference between the issuing price and the face value will be the earnings of the investors. Then we have setup notes. They have the coupon rate that increases over time. They are like growing coupon bonds. When they have only one change during the time period, it will be called single setup rate. And when it can change more than one times, then it will be called as a multiple step up note. Then we have deferred coupon bonds. In deferred coupon bonds, the payments are made after a certain time period. The payments of interest will not be started immediately after issuing the bonds. Maybe they are deferred for 2 years, or they are deferred at 3 years. Then we have, they are just like deferred income securities that we have already discussed in the previous sessions. Then we have fixed rate securities. They provide fixed interest payments at each period for the certain time period up to a maturity. Fixed income securities or fixed rate securities. Then we have floating rate securities or variable rate securities. Normally the floating rate securities, in floating rate securities we calculate coupon rate by adding reference rate with the spread or quotation margin. Here are some examples. We will discuss all these things in next coming lectures in detail, so I am just skipping this one. Then we have inverse floaters. Inverse floaters are basically the issues. These are those bonds whose coupon rate moves in opposite direction from change in a reference rate. It gives investors who believe that the interest rate will decline an opportunity to obtain higher coupon rate. If the reference rate is increasing, their coupon rate will decrease. They will move in opposite direction. Then we have callable bonds. The issuer of the bonds can alter the tenure of the bond by redeeming it before maturity. It gives the right to the company or right to the issuer to call back these bonds at any time before maturity. These are called callable bonds. Then we have putable bond. Putable bonds are basically gives the right to the investor to ask for redemption of the bonds before maturity. Remember, callable bonds give right to the issuer. The putable bond will give right to the borrower. Then we have convertible bonds. These are those bonds in which the company gives an option to the investors to convert these bonds into any other kind of securities. They can be converted into shares. They can be converted into any other loan type. Then next come yield. What is the yield on bond? This is basically the return to the investor in bond. Yield is basically called that how much return the investor can get by investing in that particular bond. It is basically the coupon return from investment of the firm. Yield is calculated by comparing cash inflows with the cash outflows by the investors. Current yield is basically how we can calculate the current yield by dividing annual coupon receipts with the market price of the bond. And it doesn't consider time value of money and complete series of expected cash flows. For example, if a 12.5% bond sells in the market for 104, the yield will be computed as current yield 12.5 divided by 104.5, and it will be multiplied by 100. That will be equal to 11.96%. Then next comes, if a pre-specified set of cash flows and a price is given, then yield to maturity of a bond is the rate at which equates the discounted values of the future cash flows to the present price of the bond. It is the internal rate of return of the valuation of the equation. In financial management, you will study this term yield to maturity, YTM, in detail. So as far as our course is concerned, we can say that yield to maturity is the point at which the net present value of the bond will be equal to the current market price. This rate will be called as yield to maturity. How we can calculate the value of a bond? It's very simple to calculate the value of a bond. We will just sum up the present values of all future cash flows. That will give us the answer of the value of money. This is the very basic formula to calculate the value of the bond. This is the general formula to calculate the value of the bond. But again, I will tell you that we will calculate the value of bond according to the cash flow stream. According to the cash flow stream of the bond. Now next moving, normally the price of the bond will be increased, will have an inverse relationship with the yield. Higher the yield, lower will be the prices, and lower the yield, higher will be the prices. Here are some what are the principles regarding the calculation of the yield to maturity. The price yield relationship between bonds is not a straight line, it's a convex. This means that the price changes for yield changes are not symmetrical for increases or decreases in yield. The sensitivity of the price to changes in yield is not uniform across the bond one holds. Here are some other principles. You can just go through these principles. Now yield curve is drawn from the yield to maturity bonds. How we can draw the yield curve? Here is an example. From this example we can easily understand how we can calculate the yield to maturity. So in this particular case, we are given different kinds of bonds and their coupon interest rate and time to maturity, term to maturity, and their prices are given, and the yield to maturity is also given. From this example, if we draw a curve composed of prices and yield to maturity, we can get a convex type curve. So this will be the yield curve in which we have drawn according to time to maturity. Yield curve, it is basically the relationship with the yield curve tells us the relationship between term to maturity or time to maturity and the yield to maturity. So we can say that as the time to maturity is increasing, the yield to maturity will also increase. So here are some more according to the risk associated. We can have different principles. These are the standard criteria to take different kinds of decisions. If coupon rate is equal to yield required by the market, then we can say the price will be equal to par value. And if coupon rate is less than the yield required by the market, then prices will be lower. And if the coupon rate is higher, then the prices will also be higher as compared to par value. So we can say that the yield will be issued at premium. In the second case, yield will be issued at discount, and in the first case, yield will be issued at par value. Now moving further, the call and repayment of risk. So in that particular case, in that particular option, the cash flow pattern of a callable bond is not known with certainty, because it is known only when the bond will be called. And reinvestment of the risk, it gives us the option to reinvest the interest rate. Default risk is basically the risk which is involved with the chances of default of the issuer. The global markets, basically we can divide the global markets of the bonds into two categories: internal bond market and external bond market. And internal bond market will be divided into further two categories. First one is the domestic bond market, and second one is the foreign bond markets. So here is the explanation of the domestic bond market, which are issued and traded within the domicile of this country, within the geography of a country. That will be called as a domestic bond market, and the bond market in which the international bonds are being traded, which it is called the foreign bond market. Here are some more explanation of the bonds, external bond market. Then we have dollar BALIC and euro BALIC. These are some classification of the terms of the trading blocks. Here are some examples from different countries. You just go through, like Australia, Canada, Japanese, emerging markets. This is all about our today's lecture. Thank you so much. If you have any question, you can ask me. Bye bye. See you in the next class.